My name is Frank Fantozzi, President of Plan Financial Services. I deeply want to welcome everyone to our 15th annual Economic Summit. We got a lot of big news tonight. We have some great speakers, one to talk on the economy, second, a little motivational speaking. I do want to remind everyone that the Botanical Gardens is open till 7:30, so afterwards, if anyone, it's a beautiful night. If you want to go through the gardens, please take advantage of that. And also make sure on the way out you have your parking validated, so the parking's complimentary, so make sure you don't lose your ticket, or if you left it in your car, go out and run and get it stamped. I will be doing a little State of the Union in a second, just to kind of bring you up to speed on what's happening at the firm. But I do want to introduce our team. So as I call your names, please stand up. First, our Chief Operating Officer, Joe Rogers. He's also part of the management team. Hey, he likes Alabama, so I don't know if that changes your tone there. Our wealth advisor, and Joe's part of the management team. Wealth advisors are Cynthia Yang, Chelsea Hussey, and Danielle Lachard. Both Cynthia and Chelsea are part of the management team as well. Then we have Mike Rinaldi, who heads our retirement plan division for our 401k plans. Yeah. Then our client liaisons, Joan Barecki, Veronica Kalinsky-Adams, who also is our tax service coordinator, and then a newer employee, Jennifer Dameron, who joined our team this year. So if you can all stand up. There you go. Come on, don't be bashful. And really brand new, because she only started 2 days ago, our wealth planning liaison, Jessica Patton. There you go. And then my executive assistant, Vicki Giancola. She's got a pretty hard job to keep me in the guardrails. Yeah. So that's my office team, but I have a home team, and I want to introduce my wife, Paulette Fantozzi. Oh, I forgot. Well, I was going to. Okay, thank you. See, I have a home team. Well, I'm going to get my home team standing up, and then I'll come back and thank one other person. So, my beautiful wife, Paulette Fantozzi, and my daughter, Nicole. So I need an office team and an at-home team. I was saving Michelle for last, because she's the one who. Yeah, so Michelle Vallado is actually the longest tenured employee at our firm, who really does all the hard work in getting this event. So a lot of thanks go to Michelle to putting on a very flawless event, all the great food, drinks, and all that. And why don't you tell a little about our drink? You had our signature drink, the mojito that you.
I thought it would be special because this is our 15th year, so it's a blueberry mojito, just a little refreshing.
Yeah. Additional thanks has to go to our sponsors. Without their partnership, this kind of event doesn't go on, but they also play a very important role to our firm. Besides having great investments, they have a deep research departments and technicians that we work with on a weekly, monthly basis. So they really are like adjunct faculty to what we do. While we have a lot of brain power in the firm, you're only as good as the team you build, and so they're really like an extension of the team that we have in the office. So I'm going to read off the company's names. I think there's a slide that shows them up here, but Alliance Bernstein, BlackRock, Blackstone, Calamos Investments, Eaton Vance, Goldman Sachs, Janus Henderson Investors, John Hancock, JP Morgan Asset Management, who's sponsored one of our speakers, Phil Camporeale, as I'm saying it right? Good. Lincoln Financial, Low Core Funds, MFS, New York Life Investments, who brought in Dr. Kevin Elko, who speaks second, Invesco, PIMCO, Victory Capital, and Harbor Capital Advisors. So a round of applause goes out to that group. I think one of the longest days we always have at the office is when we do our due diligence meetings. Cynthia brings in all these partners, and we actually grind them 45 hours at a time. We meet with each one of them, asking a lot of deep questions, trying to find out what's going on in the markets, what's going on with their investments. So, we do put them through the ringer in regards to our due diligence, but they do a great job. So thank you for that. So I'm going to give you a little state of the union, some changes that are going on with the firm. All good stuff. I'll make sure I get this right because we have some technology challenges here. All right, we're going to leave that up so I can do this correctly. And excuse me, I have to learn to do everything left-handed, and I'm not left-handed. Yeah, all right. Okay. All right. So I'm ready to go with it. So our firm is actually going to be approaching our 30th year starting January. So it's hard to believe I've been at it for 30 years with the firm, and then probably, 6, 7 years before that when I was in public accounting. And when I started the firm, you had to have a name. And, people say, what's in a name? Well, everyone here has a name. And your name is your calling card, right? And, if I name off a bunch of presidents, people are going to have different opinions and maybe visceral responses to some of the names you would say. Same thing with athletes, right? But your name, carries your credibility. It carries your authenticity of who you are. And when I started the firm, Plan Financial Services, it was really, I didn't have a lot of marketing background. I came out of public accounting. I was just trying to think of something that was functional, straightforward, to tell people this is what we do. And I feel that Plan Financial Services has done just that. I think we have a very strong reputation in Northeastern Ohio. We stand behind our work. We do everything really, really well, and we work hard as a team. That's part of the reason why I never named the firm after myself, because I always got asked questions early on, like, why don't you name the firm, Fantozzi Financial Advisors? I never really wanted it to be about me, because I knew one day, I'm not going to be around doing all that work. But I also knew we were going to build a firm and we're going to build a team. I knew it wasn't going to be a firm that was just revolving around me. And I think we've accomplished that in 30 years with the team we have. But one of the things that happened internally, and I don't know if really people picked up on it, but if you read a lot of the correspondence we have and the messaging, or you look at our website, there's a mantra that we've developed in our firm for a long time, and it was called Return on Life. And it really is about our viewpoint on what we do. We feel a lot of companies look at your money first and not look at yourself, your life. And at the end of the day, while some people might identify with money, I can't generalize to say not everyone identifies with money. But at the end of the day, what I think our clients look for is how do they establish a life well lived? How do they personally define their financial success, their family success, their personal success, even their career success? So when I look at our clients, I think that's what's always first and foremost. And so return on life has always been an internal mantra. But just like you grow up as a person, you develop your own personality and your own kind of value system. We decided as a firm, and there's some story behind it, and I'll share that in a second. We decided to change the name of the firm to really wear our mantra more on our sleeves. So with that, I think if it works, there we go. So we're going to be changing our name to Return on Life Wealth Partners. So instead of having just a tagline and kind of being embedded in our advertising or our letters, we really want to wear it out front because that's what we believe we stand for as a firm, and we feel that that's what we want to continue to do. Now people are going to say, well, what else is changing? Internally, nothing is changing. The way the team works, how hard we work to care for clients and be responsive is not going to change. Our processes are not going to change. Now, we're always going to still evolve. I can't tell you, in the days when I started the firm, I was filling out trade tickets on paper and faxing them in. That's kind of, some of the CPAs here I know will say the same thing, filling out tax returns by paper and, we weren't even using computers. That's all changed in 30 years. So we will, one of our internal value systems is always to improve continually. I think we've always demonstrated that as a firm in some of the services we've provided, some of the technology we use, the services we've added over the years. But the way we care for people is not going to change. One of the things I learned early on is, we have a lot of smart people in this room, a lot of smart people at our firm, but people don't care how much you know until you show them how much you care. So you need to figure out, as a firm, how do you demonstrate that? Because people don't want to listen until they know you have their best interest in mind. So we're very proud of the fact that, and we did it with a lot of deliberation, and people are asking, okay, well, why after 30 years? So part of that has to go with our growth strategy and where I want to take the firm. Our goal, and part of it is, thinking, so we talk to our clients about business planning and succession planning, right? We talk to our non-business owners about doing your estate planning. Why? at some point there's got to be a transition in your life. Whether you want it or not, it's going to happen. And it would be irresponsible on my part if I don't think about, okay, where is the firm going to go when I decide to slow down? And I'm not looking to slow down. I got plenty of gas in the tank and all that. But I have to build a great team and focus on where the company's going to go. So the hope is, and the plan is, because someone also told me hope is not a strategy, you got to figure out how to execute. The goal is to develop an employee-owned firm at some point. And the target is 5 to 7 years. For that to happen, we need to grow and double. And the reason why the doubling came in mind, it wasn't like a 4X or a 2X, but when you do the math to figure out how to do an employee-owned firm, there are some technicalities that I'll spare everybody here. But really, the numbers we have to hit is we have to double as a firm. We have to probably be somewhere between 20 to 25 employees. And for that, and we've been growing successfully, and we can continue to do that. But to really become an employee-owned firm, you need to have a certain amount of scale and size. And that's really what's driving that. So we felt with that decision to grow, why not introduce the name that we really live by internally and just, again, wear it out on our sleeves. So that's the plan. The plan is in 5 to 7 years, we'll start the transition to an ESOP if we can hit the growth numbers. And then at that point, we have continuity. Because one of the options any business owner has is they can sell the company. And while I've been courted to sell the company, I've been talked to about it, and even my board sometimes say, well, why don't you sell it when you're tired? I go, well, one, I'm not tired. I love what I do. I love serving people, and it's fun. It's if anyone knows me a lot, I'm very competitive, and so part of running a company is being competitive. How do you figure out how to do it better than the next guy? Because I'll be everyone knows, if we've ever been in meetings, I'm very candid and very transparent. In Cleveland, while the city's a great city, our population hasn't changed a lot. In fact, over the years, it's decreased. So if we're going to grow, the only way we grow is we have to be better than the other team, and we have to win. And the only way you win is by taking clients from the other team. That's the way it's going to work. And so we feel that by developing this strategy and wearing our name out on our sleeves, that there are certain people that are going to gravitate to a firm like ours. And that's the plan. And so that's why we're very proud to announce the name change. So it'll be effective beginning of October. And off to the races. I think from a standpoint of how we work with other professionals and our clients, nothing's going to change. Again, our commitment to you is we're going to always continually improve as a firm and figure out better ways to deliver advice, to deliver service, to make sure that the way we care for you aligns with your family values, and where you want to head. So that's the big news. Wow, it's quiet. Thank you. So our first speaker is Philip Camporeale. He's the managing director at JP Morgan Asset Management. He is a portfolio manager who develops and implements global macro trading insights with a focus on the impact of global monetary policy on asset prices. Phil joined the multi-asset solution teams in 2011, and prior to his current role, he managed the investment specialist team on U.S. funds. An employee since 2000, he was previously a portfolio manager in New York in the fixed income group, where he was responsible for managing duration and yield curve strategies. Phil has also appeared in various media outlets, including CNBC, Bloomberg, and the Wall Street Journal. So Phil, I'm going to let you take it away here.
Okay, beautiful. Thank you. Thank you. And congrats on your name change.
Thank you.
Maybe I'll ask Jamie Dimon if JP Morgan needs a name change. I'll see what he says. But congratulations and good luck.
Thank you.
And it's so good to be here, and it's good to be in Cleveland. I haven't been here since post-COVID, and I remember when I was here the first time, Lori, who's my partner here in the territory, took me to Little Italy in Cleveland. And I came back to New Jersey, and I'm not sure how many people know how prideful we are about our Italian food in New Jersey. And I said, Cleveland has the best Little Italy that I've ever been to. And I'm not just saying that. It was really, really, really good. So, as was mentioned, I started JP Morgan all the way back in 2000. Okay, so it still was this millennia, but it was the first year of this millennia. All the way back in 2000, it was my first job out of college. I graduated from Fordham University in the Bronx. And I remember the first question that they asked is, why do you want to work at JP Morgan? Like, why do you want to do asset management? And I thought of my mother. My mother is a 35-year veteran of the New York City Board of Education. And she had zero idea about capital markets and the stock market, but she knew that somebody needed to take care of her retirement, of her pension, of her wealth, of her money, of her, future. And I thought that obligation of running somebody else's money was so inspiring. And that's what I said. Why do you want to work at JP Morgan? Well, I think that the obligation of running somebody else's money is inspiring. It's something that I take very seriously. It's something that your advisors take very seriously. I still believe that today, 23 years later. And this is why I like doing events like this. I mean, financial advisors are nice, they're fun, but when I get to meet the end clients, right, it kind of fires me up, gives me more passion to do what I do, because I think of that first day that I had on the job. So as I mentioned, I live in New Jersey. I was born in Brooklyn. Anybody born in Brooklyn here? Everybody? There you go. That counts, kind of. But everybody kind of starts, for some reason. I could be anywhere in the country right now. And if I say somebody born in Brooklyn, I know I'm going to get somebody. Everything kind of starts in Brooklyn. So I was born in Brooklyn, and then when you're born in Brooklyn, you have to decide, or your family has to decide, one of two things. Do you go east to Long Island, or do you go west to Staten Island? So I went west to Staten Island, so I was raised there, and then I moved to New Jersey in 2003, and I've been there ever since. So I'm a lifelong New Yorker, even though I live in New Jersey now. I'm a lifelong New Yorker. But I'm really happy to be here because there are things happening in the market right now. Like sometimes I feel like I need a motivational speaker every day, especially last year, to come to work based on stuff that are happening in the market that I want to talk about. Because there's a lot of noise and there are a couple of signals. And the signals is what really matters. Because sometimes, for some reason, news channels are able to find 30 pieces of breaking news every single day. How do they do it? How do they find all of this news? I know how they do it because they sell commercial advertising. That's why they do it. But a lot of that is noise and a lot of that is scare tactic or fear mongering. And I just want to kind of talk about some of the signals today. All right, so what you see behind me, I'm going to just kind of go through a couple of high-level themes tonight. My job is not to pick stocks and not to pick bonds. My job is to do something called asset allocation. So it's find diversified portfolios, which I'm sure guys know a lot about, some stocks, some bonds, some cash, a mixture of everything to create an outcome for clients to just stay invested. So don't ask me for a hot stock tip, I don't know one, because we're active asset allocators. What we're trying to do is keep people invested. So I want to start here for one particular reason. This is a diversified portfolio. This is a balanced fund. The green lines are what happens to the stock market every calendar year, and the gray bars are what happens to the bond market every year. And something happened last year to the point now where I wake up every day and I say, thank goodness it's not 2022 anymore. Because something happened last year that hasn't happened since 1974. For the first time since 1974, both the stock market and the bond market went down. That has not happened since 1974. Now, that's not supposed to happen because usually if your stock market is doing well, then maybe not your bond market is doing so well. Or more importantly, for managing risk, if the stock market is going haywire, like it did last year, your bond part of your portfolio should be higher. But we had a historical situation last year where inflation in this country, as a result of the pandemic, hit 9%. 9%. I never in my wildest dreams, nightmares, would ever believe that the United States of America would have a 9% inflation rate. But that's what happened. And what it did was it caused the bond market. Okay, so this is just the bond market now. Look at this great ride in the bond market since 1976. Most of the time the bond market is positive or going higher. Yeah, there were a couple of years where the bond market was lower. But what bar really sticks out here? Last year. The bond market had its worst year in history. Not just a bad year, it's worst year ever. Ever. Okay, so we can cry about last year, which I did, or we can say, okay, what is the opportunity that it's creating today? Because Warren Buffett said something, he's a billionaire, he can say whatever he wants. Warren Buffett said, be fearful when others are greedy, and be greedy when others are fearful. Easy for him to say. He's a billionaire, right? But it taps into a little bit of what I want to get at today. Because the answer to these first two charts has been an astronomical increase in money market funds. People believe. There's $5.5 trillion just sitting in money market funds right now. We've never seen anything like that before. Because most people believe, okay, I'm just going to sit in cash. Because last year everything went down and I'm scared. Okay? And I'm just going to sit in cash because finally I'm getting a reasonable return. So I want to address the pitfalls of that as well. All right, I want to talk about my friends in Washington, D.C. Just as an aside, on a personal note, I have 3 children, 18, 17, and 15. Just dropped my 18-year-old off of college down in D.C. It was great. It was like we were going on vacation, and then she just didn't get back in the car for some reason. So I'm kind of emotionally dealing with that a little bit because she's a great mix of my wife and I. My youngest is a wacko and like me, and my son is like my wife, and Julia is a great mix of the both of us. So the house is a little bit in disarray right now, but we're getting used to it. But another person that's in D.C. is Jerome Powell and the Federal Reserve, okay? And if you look at this roller coaster, as you all know, there has been a tremendous amount of interest rate increases by the Federal Reserve. For a long time, post the financial crisis, the Fed declared war on the elderly and the savers of this country. They took interest rates to 0. And then they started to raise interest rates from 2015 to 18. Trade war got them to cut interest rates to between 1% and 2%. Then obviously COVID, they doubled their balance sheet from $4 trillion to $8 trillion, took rates to 0. And then the inflation genie got out of the bottle. And they had to just do a incredibly aggressive, look at that line last year going higher, interest rate cycle. They moved by 550 basis points, or 5.5%, in just over a year. At one point last year, they were moving interest rates by 0.75 percentage point, 4 meetings in a row. Never done anything like that. That was scary. There was nowhere to hide last year, unless you had some brilliant idea to just take all of your portfolio and put it in either commodities or cash, right? Those were kind of the only 2 things that kind of worked last year. Cash just didn't lose any money. So where are we now? And this is a little dated because yesterday the Federal Reserve met, and I just want to give you a quick synopsis of what we expect in the future. They met, and we expect them to do 1 more interest rate hike this year. That's okay. 1 more. They've already gone by 550 basis points. Why not 1 more? So 1 more in November, and then they stop. But I want to be really clear about something. We only have a 20% probability of recession over the next year. That's very low. At any point in time, the probability over the next year is usually around 15%, no matter what's happening. So we're a little bit above that, but we are clearly not of the view that the US economy is going to slip into recession over the next year. I just want to be really clear there. Now, that's the good thing. You can't have your cake and eat it too. You can't believe that the US economy is going to avoid recession and believe that the Federal Reserve is going to cut interest rates. So we don't have the view that the Federal Reserve is going to cut interest rates for at least the next 9 months. Maybe they do 1 interest rate cut at the end of next year. But all you need to know about interest rates is that they're going to probably finish with 1 more hike in November and then go on hold for a while. And that's okay. The whole reason why they're not cutting rates is because there's no crisis. Anybody in this room want a crisis? No. The only people that want crises are the people that have, all the bonds in the portfolio. So this is not an environment, we think, where inflation is going to reignite, but also importantly and positively, not an environment where we believe the US economy is going to slip into recession. Last year was very traumatic. Last year was historic. I just told you it was the first year since 1974 that both stocks and bonds went down in the same year. So unless you think that can happen again, this is where we start to offer up what are the opportunities to take advantage of the current environment. Okay, let's talk about inflation for a second. Okay, the left-hand side of the page, in the summer of last year, inflation was at 8.5%. That is not an emerging market country, folks. That is the United States. And it came from everywhere. Everywhere. It came from goods. Because everybody were demanding goods at the same time. We had supply chain shortages and things like semiconductor chips. We had new and used vehicle inflation because of that. Even in New Jersey, I was paying over $5 a gallon in gas. We are not used to those numbers in New Jersey.
No, we're having a hard time hearing you. Could you maybe move your mic closer to your tie? Thank you, Phil.
Is this any better?
Yeah, it's
Oh, it goes in and out? Should I use the microphone?
yeah, maybe that might be better. Thank you, Phil.
This is where I do the Verizon. Can you hear me now? Hold on. Is it on? Is this better?
Yes.
Okay, perfect. So let's start with inflation. Even in New Jersey last year, we were paying at this point in time $5 a gallon for gas. So look at the green part of that. You had energy prices contributing, new and used vehicles, restaurants, shelter, food at home, everything was contributing to 8.5% of inflation. Now, since then, we've gone from 8.5% all the way to about 3.2. The goal, the whole goal here is 2%. So we're still far away from that goal of 2%, but we have certainly made progress here. That's the good side. On the other side, this is the stuff that we expect to stay what we call sticky. So the move from 3% to the goal of 2%, we just don't think is happening anytime soon. The last mile, if you will. So this was really good. It happened, 9% to 3%. But because, importantly, this is critical, the labor market is so strong right now, and wages remain strong, we would expect some of those stickier parts of inflation to stay there. What are those things? Things like airline fares. How many people overpaid for airline fares this summer? How many people went to Europe this summer, by the way? Right, yeah, I mean, so many European vacations this summer. So airline is a great example of that. If somebody has a job, can you hear me? Yeah, if somebody has a job and has wages, they're going to be paying for things like airline fares. So that, again, the good part is they have a job. The labor market is strong. The bad part is we're not going to see 2% inflation anytime soon. Now, there's one good way to get to 2% inflation, or easy way, not good way, and that's to have a recession. And again, if we don't expect a recession, then we expect the labor market to stay strong, and then inflation somewhat sticky around these levels, which is, again, all goes back to the fact why we don't believe that the Federal Reserve is going to cut rates anytime soon. So it all kind of goes together. Okay, now I want to talk about what's behind me. If you go and you look at, okay, can I lend the US government money for 30 years? Or if I lend the US government money for 3 months, this is totally inverted right now. Usually, if you're lending to somebody for a long amount of time, you're going to want a higher interest rate. Even the US government. But right now, all of the yield, this is important, all of the yield is concentrated in the very, very short part of the curve. So this is my biggest competitor right now. My biggest competitor is not another bank or a fund family. My biggest competitor right now is the 3-month T-bill. Because everybody believes that if you have a 5.5% rate in a 3-month CD, a 6-month CD, that's risk-free. Now, true, cash is an ultimate risk-free rate of return, but it doesn't have no risk when it comes to opportunity cost. So what else can you get out there? And again, I don't want to talk to folks about, if you need cash, if you belong in cash, if that's really your risk profile, if that's really your liquidity situation, that's great, because cash rates aren't zero anymore. I'm talking about folks that last year saw that all heck was breaking loose in the stock and the bond market, and they just said, get me out, and they haven't come back. Because that 5.5% rate of return, how long does it take to get a 5.5% rate of return on a 3-month T-bill? It takes a full year. And you have to, every 3 months, you have to, re-roll that. So if that 5.5% takes a full year, and I started with the fact that that diversified portfolio is up 11, that's not a risk-free rate of return in my opinion. And again, this isn't a story about should I be in cash or should I be in NVIDIA. That's not what we're talking about here. We're talking about folks that were diversified before the chaos of last year that should probably be diversified today because last year was such a historical anomaly. First time since 1974 that both stocks and bonds were down in the same year. You don't position your portfolio for things that happen once every 50 years, no matter how much breaking news the media has. Okay. Here's another way to frame that story. Okay? If you have a 6-month CD, this is the rate of return on a 6-month CD in the year after the Federal Reserve stops raising rates. And if I'm right, I believe that November is going to be the last time the Federal Reserve raised rates this year. So that's what happens to a CD in the following 12 months after the Fed stops raising rates. We believe they're going to stop raising rates in November. The other colors are all the other assets. So the green bar is the equity market. The light blue bar is high yield or corporate credit. And then the dark blue line or the purple line are core bonds. Why don't you take a look at these lines? The 6-month CD, once the Fed stops hiking rates, gets left in the dust compared to either safe bonds, core bonds, high yield bonds. I don't like to call them junk bonds. That's so insulting. Or the equity market. And again, this isn't should I be in cash or should I be in equities. It's what happens to cash after the Fed stops raising rates. And if you go back to each one of these 6 tightening cycles, every time the Fed stopped raising rates, 6-month CDs got left in the dust. Okay, what I really want to talk about today, though, is why has this economy been so strong even though the Federal Reserve has raised rates by so much? If we believe that the third quarter growth in this country is going to be about 3%, that would mark the 5th quarter in a row that the U.S. economy grew more than potential or above trend. And that's the exact same time that the Fed did their most aggressive cycle. Mark Twain, I love this quote, it applies to investing. Mark Twain said, "It's not what you don't know that gets you into trouble, it's what you absolutely know for sure that just ain't true." 12 months ago, we should have been in recession. 9 months ago, we should have been in recession. Silicon Valley should have put us in recession. Well, we should have been in recession over the summer. We should be in recession today. Some people believe we're going to be in recession in December. 5th straight quarter this quarter of above trend GDP growth. So why has that happened? And I'm going to tie this back to the U.S. consumer. The U.S. consumer never bet against the U.S. consumer. 70% of the U.S. economy is consumption. If we were a country, we'd be bigger than China. It is the most important consumer to get right. I'm showing some housing stats here because I think the answer lies in the housing market. First of all, why has a 7.5% mortgage not crushed the housing market? Well, Economics 101, supply and demand, top left-hand corner, 2008 was so traumatic for home builders that we have never recovered in terms of inventories in this country. So housing inventories are still scarce, and that's a big reason why the housing price market has kept up. In the bottom left, rental vacancy rates. There are no empty apartment buildings. And that's part of the commercial real estate story. Apartment buildings are part of commercial real estate. So not all commercial real estate is scary. That low vacancy rate is really important. And look where those numbers are versus where we were in 2008. But the consumer is where it's at. And here are some stats that I want to share tonight. So out of every U.S. homeowner, everyone, 40% of U.S. homeowners do not have a mortgage. That must be nice. So 40% of U.S. homeowners just own their home free and clear. So 7.5% mortgages doesn't mean anything to them. Of the remaining homeowners, 85% of those homeowners have a fixed rate mortgage with an average rate on that mortgage of 3.6%. In fact, there has never been a time in history where the prevailing mortgage, the mortgage that you can get at Chase, versus the mortgage that you have, the spread between those two numbers has never been wider in history. Because the 10-year note was at 50 basis points 3 short years ago, and now it's at 4.5. So if you had a brain, if you had good advice, you were going to refinance your mortgage at some point over the last few years. So again, that 7.5% mortgage rate, you know what that does? That probably prevents speculation. Because why the heck would you ever want to sell your home if you're sitting on a 3.6% mortgage to go on a 7.5% mortgage if you need financing? So that's good. But what it doesn't do is crush the consumer. The household debt service ratio, that's the percentage of debt payments, all debt payments, housing, car, mortgage, whatever, credit card, all of those payments as a percent of your income after your expenses. And look at where that number is. It hasn't budged. It's only back to where we were pre-COVID in 2019. So there's a story here where the U.S. consumer, even though interest rates have gone up by so much, doesn't care. They're sitting on a 3.6% mortgage. The cash rate is 5.5%, and their mortgage rate, their biggest expense, is at 3.6%. So that debt service ratio, even though interest rates have gone up by so much, hasn't moved, which again, bring this back to the economy. If 70% of the US economy is consumption or the consumer, that chart really matters. The next chart that really matters is credit card outstanding. There are a lot of people that are going to say scary things about people defaulting or being delinquent on their credit cards. And they say it's starting to rise. Okay? And the question that you need to ask is, where is it rising from? The bottom right hand. Yes, that line is starting to rise. But again, only back to where we were pre-crisis. And it's only really happening in lower income cohorts. Now, this is an investment discussion. This isn't like a kumbaya moment that everybody should have the same things. But the top 20% of earners do 80% of the spending in this country. So again, if people are going to tell you and try to scare you and say delinquencies are starting to rise in credit cards, it's rising from a low level, and it's not anywhere in the higher income brackets that do most of the spending anyway. Okay. Just a couple of last ones before I open it up to Q&A. This gets back into the behavioral stuff. I love this chart. Every month, the U.S. government releases a consumer sentiment index. They basically ask consumers, how do you feel? Okay, back to that Warren Buffett quote. Be greedy when others are fearful. Be fearful when others are greedy. This goes back to 1971. That's 50 years of data. Every time consumers say they're feeling the best in a particular cycle, we mark it with a circle. And every time consumers say, we really feel awful, We mark it with a circle at the bottom. If you can see it, take a look at that table up top. Every time this sentiment number peaks, market goes up a little bit, 3.5% over the next 12 months. But every time folks say, like they did in June of 2022, when inflation in this country was 9%, gas prices were averaging over $5, every time they say they feel the worst, the average return over the next 12 months is 24%. Right now we're sitting at 17.6. 17.6. And this isn't just, I'm not cherry picking June of 2022. This goes back 51 years. This is just really important to keep in mind. And cash is not going to get you to your goal using a chart like this. All right, and then finally, I want to leave it on here. There are two things, back to that diversification point, there's two things that you should always have in your pocket that are going to be the best antidotes to any volatility. Doesn't matter who wins the election next year, doesn't matter if there's growth or if there's recession, it doesn't matter if we're war or peace, it doesn't matter. There's two things that everybody should have in their portfolio and you're going to be fine. The first thing is time, T-I-M-E, time. If you ask your advisor for an exorbitant amount of return or to reach your goals in a week, I know these guys are good, I'm not sure if they're that good, right? You need a reasonable time horizon in order to reach your goals, okay? So I don't think that's 1 year, personally. I also don't think it's 20. No advisor should be telling you don't look at your statement for 2 decades and everything will be okay, right? That's not the answer either. But I want to concentrate on the 5-year part of this chart. I think 5 years is a reasonable way for you to achieve goals. So if you have time, and the second thing, diversification. What these measure, going back to 1950, so I didn't want to stop for 50 years. This is 70 years of data. Going back to 1950, the gray bars are what happens to the stock market in any 12-month period over the last 72 years. So in other words, there was a 12-month period where the stock market went up by 47%, and there was a 12-month period over the last 72 years where the stock market went down by 39%. That was the financial crisis. Bonds are better. 1 month was 43. Last year did quite a doozy to this chart, because last year, when do you think that 13% was? Last year. So that was the worst 12-month period for the bond market in history, as you can see on this chart. And then the asset allocation portfolio, the 50-50 portfolio is in gray. Here's the so what of this. You want these bars to be as small as possible, because what that does, it eliminates your anxiety and your emotions when you're investing. So that 5-year rolling period, take a look at the gray bar. There has never been in history, over the last 72 years, a 5-year rolling period where a diversified portfolio has ever lost money. That's a pretty strong statement. Obviously, as you get out to 20 years, everything kind of shrinks. Stock market goes up most of the time. You're usually fine over time. But it's disingenuous to tell somebody to wait 20 years. I think the 5-year period is something we should be keeping in mind when there's $5.5 trillion of cash just sitting on the sideline. That rate, 5.5 of today, could be gone tomorrow. That's called reinvestment. We don't expect that. But even JP Morgan isn't right 100% of the time. Anything can happen over the next 12 months. The Federal Reserve can be cutting rates like crazy because of some crisis in 6 to 12 months. So again, that 5.5% rate today, we think peaks out around here, and the next move is lower. So I want to leave it there. Frank, anything that I didn't talk about that you think I should address, or anyone in the audience, anything that I should address? Yeah, go ahead, please.
I'm just curious because it's been recent, the auto industry strike.
Yeah, so there's 3 things that we're keeping an eye on. The gentleman mentioned one of those things, the United Auto Workers strike. Just as an aside, so I mentioned my daughter started college, and for some reason she wants to be a finance major. I have no idea why. And she texts me, Dad, do you know any current events in business right now? I'm like, oh, Jewel, where should I start? So I did give her the United Auto Workers story. So there's a couple of things that we're keeping an eye on. One is the government shutdown, okay, potential for a government shutdown. The second is the United Auto Workers strike. These are a couple of things that we think have some downside risk to our forecast. So if you play out the strike, okay, that's lower growth and potentially higher prices or higher inflation. It's just too soon for us to make a comment on that, but that is the downside risk. There's no upside risk to it. So the downside risk would be more of a, if we saw what happened to car prices when semiconductor chips were hard to find. Well, what if cars are hard to find, right? So that's something that we're certainly keeping an eye on. We don't think it's enough at this point to push the U.S. economy. It's 2 consecutive quarters of negative GDP growth with a cut in jobs, and that's the definition of a recession. Go ahead. My Brooklyn girl.
Yes, I'm going to ask a Brooklyn question.
Go ahead.
Could you address the environmental disasters that we are seeing that are no longer once in 100 years? What is the impact of hurricanes, fires?
Yeah. Yeah, so the impact on that is higher insurance prices. So that's inflationary. That's inflation. So it's not obviously we can have like a whole moral discussion about this. That I wasn't asked to talk about that. But I will say just from a price standpoint, all of this leads to higher insurance prices, which goes right into inflation. And that just keeps things really high. And growth isn't going to be great if we keep having to spend on these things, for sure. Go ahead.
Question regarding the war in Ukraine.
Yeah.
The long-term effect has been 19 months. It doesn't look like it's going to happen. How will that affect its
Yeah, so absent an escalation, which we can't foresee, the impact on gas prices in the U.S. just isn't happening. Also, God kind of chose a side last winter in the Russia-Ukraine war by delivering a 3 standard deviation warm winter to the continent of Europe. So they looked like they were in a lot of trouble because of the liquid natural gas story. Now, we don't know what's going to happen this winter, but last year bought them some time. And with what we know now about that crisis, not enough to affect our U.S. story. But the China story is kind of akin to that, the China-Russia story. So, China has a real estate problem right now. They have a lot of things going on. But one of the things that investors care about is their real estate market. And I think that affects Europe more than it does the U.S. And it also involves kind of our emerging market equity allocation because it's such a big part of that. So if there's one thing you can take away from this is we're probably more bullish on the U.S. now than we were earlier this year because of those reasons. Yeah, please.
What about all this expense with the war and the money? What's happened to our dollar compared to the money?
Yeah, the dollar's doing well because the U.S. economy is growing more than other economies. What you're addressing, though, is a serious deficit issue to the point where we were downgraded again in August, this time by Fitch. In 2011, it was by S&P. That's part of the reason people are giving why interest rates went up, along with what the Federal Reserve was doing. So I think ratings agencies and investors want more compensation for lending to the U.S. government right now. And there are ways to fix it that are politically unpopular that no congressperson that doesn't have a term limit is willing to do. Please.
Yeah, I was under the impression of inflation.
Yeah.
I saw food prices and energy prices.
Yeah.
I always thought they were excluded from the inflation calculation.
Mm-hmm.
So wouldn't you look at inflation as being understated?
Yeah, good question. So that left-hand side is what we call headline. Headline inflation includes energies, food and energy. The Federal Reserve, for some reason, doesn't care about anyone that eats or drives. So they make their policy decision based on the fact, right or wrong, I don't believe this, you don't believe this, that energy and food prices tend to be volatile, so they don't want to be swinging around interest rate policy based on a hurricane that maybe, or a war that creates high oil prices, or a drought or something affecting food prices. So that's their story. I'm just the messenger for that story. But yes, it is understated versus core that excludes that. Absolutely. Please.
So you talked about labor market strong.
Labor market, yeah.
Yeah. So, but we can't find workers for
Right.
landscape, food industry,
Right.
drivers, things like that. How?
It's not just Ohio. New Jersey's the same thing.
I'm sure. Is it ever going to stop?
Yeah. So the question was about you're not able to find workers. You're not able to find labor if you want to do capital improvements, if you know, landscaping, whatever. I think that's true. There's right now in this country 1.5 job openings to every one person that's unemployed. If you can't find a job, you're not looking for one. That is improving. We were two open jobs for every one worker at the height, and it's coming down. I think what the Federal Reserve, and this is a slippery slope, and they're playing with fire here. They actually want to see the labor market weaken, because if the labor market weakens, okay, that means that inflationary pressures in theory should come down. But labor market weakening can also lead to recession. That's not something that they want. The only way to really fix what you're talking about is material immigration reform. Material immigration reform. David Kelly has talked a lot about that. And again, back to the deficit question. When Congress people don't have term limits, they don't make tough choices. So we are short labor supply in this country, absolutely. And demographics is only going to make that worse.
Just like the brown that they were just talking about into New York. And
Yes.
Phoenix
Right. I've seen a lot of new faces in New York City, for sure. Okay, thank you everyone. Appreciate it.